European Union finance ministers agreed on Wednesday the latest reform of the bloc's fiscal rules, allowing more time to cut public debt and creating incentives for public investments. Debt levels were pushed to record highs by pandemic recovery programs. The new rules are more lenient than the previous framework, marking a win for the mostly southern countries led by France, and come at a time when the region is expected to embark on a new spending to keep its climate and security goals on track. Eurozone debt, while declining, remains historically high at around 90% of gross domestic product. But these 6 countries, Greece, Italy, France, but also Spain, Portugal and Belgium, have a debt to GDP ratio in excess of 100%. Let's get more on this now with Vicky Price in London. She's an economist and board member at the Centre for Economics and Business Research. Thank you very much for joining us today. Vicky, highly indebted countries like Italy, after some resistance, they have accepted the reform. Why? I mean, is it because they may think that after all, the new rules will never be applied in full in the bloc?
That's a very good point, and indeed they may not. It all depends what happens to the economy of Europe over the next couple of years. Of course, right now we're in recession in a number of countries. There is deflation in some countries, and inevitably, just as you said, during the pandemic, debt to GDP ratios rose in many places. The interesting thing, nevertheless, is that they have now been coming down because there has been quite a lot of tightness in what budgets have been approved in various countries, and there has been a gradual reduction in those debt to GDP ratios that you mentioned. So they're not as bad as they were even a couple of years ago. And you look at Greece, for example, where it was nearly 200%. Now, the question is, what types of sanctions might be applied if the rules, which had been abandoned, of course, during COVID in order to allow for the recovery to take place, start happening again? There is still, a requirement particularly for the countries with over 90% debt to GDP ratio, to have their budgets approved or looked at by the Commission. And that is important. And I think for them, there is an extra requirement, will be an extra requirement from next year, to in fact reduce their debt progressively over a number of years, faster than countries which are already below 90% debt to GDP ratio. So there are requirements that will be imposed, even for those countries, despite having improved the situation, are still way above what is required under the normal earlier rules, which were, remember, 60% debt to GDP ratio and just 3% deficit to GDP ratio, things which, of course, we haven't seen come back for a number of countries for many years now.
True, much lower figures, less than half. What is the enforcement, Vicky, the enforcement action for non-compliant countries? And is there a risk that any enforcement will be watered down by political compromise down the line?
I think the expectation that there would be some extra sanctions for the countries that are rather slow in getting their debt to GDP ratio back down to something resembling more normal. That has been pushed particularly by countries like Germany, which were rather concerned that these rules, as they were framed at the beginning, were a bit too loose. What basically would be required is that those countries are required per year to reduce their spending by an extra 0.5% over a period of time. And that, of course, means that in some circumstances that could be quite a tight environment for them. Now, you asked at the beginning the question, will these things in fact be enforced? I think what the Commission has been trying to say as well in the pronouncements is that there will be flexibility depending on the circumstances. And of course, we still have to have all this passed by Parliament. And we do know that the EU Parliament has tended not to be as hawkish, if you like, as some countries like Germany have tended to be in this area. So what happens in reality at the end of the day is still, pretty uncertain.
Vicky Price, thank you very much for your analysis.
Thank you.
And now let's go to other top stories from around the world. Toyota is recalling more than 1 million vehicles over a system issue which could cause the passenger airbag to fail to deploy in a crash. The Japanese car maker says the recall will affect a range of Toyota and Lexus vehicles with model years from 2020 to 2022. Meanwhile, Toyota's Daihatsu subsidiary has halted shipments of all of its vehicles after a safety investigation found issues involving 64 models. A Singapore court has ordered a $1.14 billion asset freeze on co-founders of the collapsed cryptocurrency hedge fund 3 Arrows Capital. 3 Arrows Capital filed for bankruptcy last year when the company's fortunes collapsed after a huge sell-off in assets. The court has accused some of the individuals of not returning funds and failing to voluntarily provide information. Wells Fargo's Albuquerque branch employees voted 5-3 to join the communications workers of America's Wells Fargo Workers United. This landmark decision marks the first major US bank with a union challenging industry norms. The move signals a shift in the labor landscape with potential impacts on future unionization efforts within the banking sector.